Hello and welcome to Connected with Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. In this episode of our Energy and Infrastructure podcast series, we're talking about the recent updates to the Equator Principles that took effect in October 2020 and their implications. I'm Matthew Brown, a partner in our London office and a member of the firm's Energy and Infrastructure Industry Group.
And I'm Chirag Sangrajka, also a partner in our London office and a member of the firm's Energy and Infrastructure Group. Here to discuss the updates to the Equator Principles is our colleague Josh Marnitz. Josh is a counsel based in our Los Angeles office and a member of the firm's Environmental Land and Resources Department. He specializes in this area and has a great deal of knowledge to share with us. Welcome, Josh.
Thanks. It's great to be here.
Josh regularly advises private equity firms, financial institutions, and corporate clients on environmental and energy regulatory matters, and has significant experience with the development and financing of major conventional and renewable energy and infrastructure projects in the US and abroad. So we're in good hands. So Josh, for our listeners who are not as familiar with the Equator Principles or simply need a refresh, can you provide just a quick snapshot of what they are and how they work?
Of course. Thanks, Matt. So by way of background, the Equator Principles make up a risk management framework that many financial institutions have adopted. They consist of 10 environmental and social principles and are primarily intended to provide minimum standards for lender due diligence and monitoring to support responsible decision-making when financing projects. Members, known as Equator Principles financial institutions, are subject to an annual reporting requirement to share data, which covers the majority of international project finance debt. The Equator Principles apply to projects in both developed and emerging markets, and they incorporate the International Finance Corporation's performance standards on environmental and social responsibility. Multilateral development banks are also increasingly drawing on the same standards as the Equator Principles, including the European Bank for Reconstruction and Development and export credit agencies through the OECD Common Approaches.
Very helpful. Thanks, Josh. So obviously there have been some recent changes that came into effect just last year in October. Can you give us an overview of those and what they mean?
Sure, Chirag. The Equator Principles Association adopted the most recent iteration of the Equator Principles, known as Equator Principles 4 or EP4, in November 2019. EP4 was scheduled to take effect in July 2020, but due to the impact of the COVID-19 pandemic, the transition date was extended by 3 months to October 1st of last year, that is 2020, like you mentioned. There were some very significant changes to EP4 that both project sponsors and lenders should be aware of. For starters, one noteworthy change is EP4's commitment to numerous global standards. EP4 explicitly commits to meeting the United Nations Sustainable Development Goals, the 2015 Paris Climate Agreement, the recommendations of the Task Force on Climate-Related Financial Disclosure, or TCFD, and the United Nations Guiding Principles on Business and Human Rights. EP4 also notably expanded the scope of financial products to which the Equator Principles apply. For instance, in the context of project-related corporate loans, the aggregate loan threshold has been lowered to $50 million from $100 million. The loan tenor is now at a minimum of 2 years, and loans to national, regional, or local governments, governmental ministries, and agencies are no longer excluded for certain categories of projects. EP4 also added project-related refinance and project-related acquisition finance to its scope, where the underlying project was financed in accordance with the Equator Principles framework, where there has been no material change in the scale or scope of the project, and where project completion has not yet occurred at a time a facility or loan agreement is signed. EP4 also contemplates in pretty clear terms that the Equator Principles can be used for other financial products other than those expressly mandated in the EP4 document itself. Perhaps the biggest change is that EP4 has increased accountability in relation to the development of environmental and social assessments and the application of the IFC performance standards, in particular in designated countries, which are high-income countries like the United States, the United Kingdom, etc. That fact should not be underemphasized or ignored. If you're working on a project that's being developed in the US or another high-income country, the commercial banks in the project financing, assuming they are Equator Principles financial institutions, will require the borrower to satisfy EP4. In prior iterations of the Equator Principles, projects located in high-income countries, such as the US, were deemed to be in compliance with just about all of the EPs, including the requirement to prepare an environmental and social assessment. That is simply no longer the case. A key takeaway here is that sponsors should engage as early as possible in the development of an environmental and social impact assessment and engage as early as possible with an independent environmental and social consultant or independent engineer to ensure alignment on the scale and scope of the pieces of work we just discussed, and also to come to an agreement on what exactly are the applicable environmental and social standards to which the borrower or sponsor will be subject, as well as expectations on the scope of legal due diligence and related deliverables by the borrower to the lender.
Thanks so much, Josh. There's some noteworthy things there to take into account, obviously, when looking to do a project. I'm certainly seeing the effects of some of these changes in my practice, but can you explain further about the implications for projects in designated countries?
Sure, Matt. And I apologize if I'm repeating a few things, but I think this is all worth repeating since it's extremely important. For projects located in the U.S. and other designated countries, the implications of EP4 can be significant, particularly for project sponsors who fail to take EP4 into account until later in the financing process. For context, unlike commercial banks, export credit agencies, or ECAs, have their own environmental and social requirements. For instance, they typically require a borrower to satisfy the IFC performance standards full stop, even in the United States. Commercial banks, on the other hand, previously did not take that approach. However, they are now moving toward that same position with the most recent update of the Equator principles. As I mentioned previously, under EP3, if you developed a project in a designated or high-income country, you were effectively deemed to be in compliance with the Equator principles and therefore the underlying IFC performance standards, so long as you were in compliance with host country law. But that is no longer the case. That means that projects located in designated countries that were previously deemed under EP3 to be in compliance with the most burdensome requirements of the Equator principles are now going to have to satisfy those requirements, including requirements relating to the preparation of broadly scoped environmental and social assessments. If that is not a requirement under host country law, as is the case for many projects in the US, the sponsor will nonetheless be required to prepare such an assessment to satisfy EP4. If project sponsors have not prepared those sorts of assessments, there can be a bit of a shock to the project financing schedules because those are reports that are very detailed and can be time-consuming to prepare. Projects located in the US and other designated countries may also be required to satisfy the IFC performance standards, which are an incredibly detailed and expansive set of requirements, and which may go well beyond what is otherwise required under host country law. Under EP4, projects located in the US and other designated countries could also be required to undertake a climate change risk assessment, which I'll discuss in a moment. All projects located in the US and other designated countries will also be benchmarked against the requirements of IFC Performance Standard 7 in relation to Indigenous peoples, which can be a big deal in the US in particular, where there are many Native American tribes who may live in close proximity to a project. Finally, projects located in the US and other designated countries may be required to conduct a human rights assessment that is not otherwise required under any host country law. Now, Matt, I'm curious, you mentioned you were seeing some of the implications in your own practice. What specifically have you come across with respect to EP4?
I think, Josh, as you noted, we're seeing both lenders and sponsors pay increased attention to the Equator principles at a much earlier stage in the financing process for projects in designated countries. I mean, that's obviously not to suggest that lenders and sponsors ignored the requirements previously. Instead, they typically relied on compliance with host country law to signal compliance with the Equator principles. But now lenders are raising the question of Equator principles compliance earlier in the process and requiring, the independent engineer to evaluate projects in designated countries against EP4 in addition to its sort of typical scope, which includes host country law. So, in summary, sort of seeing earlier activity and of course, much more of a focus on this as a result of the changes that you've mentioned.
I'd echo the same in our practice. It can come as a great shock to the financing schedule for parties that don't focus on this, to find that long lead items such as environmental and social assessments can pop up late in the process. We advise both lender and sponsor clients to pay attention to these requirements as early as possible to ensure that compliance with EP4 is not an unnecessary cause of delay to closing.
Yeah, that's interesting, and as I've mentioned, sort of tracks my experience as well, where I've seen both lenders and project sponsors paying closer attention to the Equator principles early in the process, and also, an increased focus on EP4 compliance by the independent engineers and independent environmental and social consultants. So sounds like we're all seeing similar trends here. I know we're getting short on time, but let me touch on a few other key changes in EP4. As I mentioned previously, some projects, especially those in the extractive industries, may have to prepare both a physical climate risk and a transition climate risk assessment under EP4. These assessments would be newly required reports, sometimes in addition to what may be required under host country law, and they largely support the objectives of the Paris Agreement. The climate change risk assessment identifying physical risks would look at direct damage to infrastructure caused by, for example, an increased intensity or frequency of acute weather-driven impacts, as we've seen recently in the United States with multiple hurricanes impacting infrastructure along the Gulf Coast. These are examples of physical climate risks. But projects must also look at longer-term shifts in weather patterns. For example, if greenhouse gas emissions are leading to sea level rise, heat waves, or other types of physical impacts to infrastructure. The assessment can also look at indirect impacts to supply chains. For transition climate risks, the assessment is looking at drivers of transition to a lower carbon economy. In some countries, there are various policy and legal drivers, such as mandated emissions limits, carbon pricing or taxation, and the offering of incentives. There are also technology and market drivers, which can include changes in demand for conventional energy sources or supply due to technological changes. Both of these documents look at these types of risks and align with the Task Force on Climate-Related Financial Disclosures, or TCFD, which I mentioned previously, in order to help lenders assess financial risks. Finally, as I mentioned previously, another development that is captured by the updates to the Equator Principles and bears mention is the concept of free and prior informed consent, or FPIC. FPIC applies when a project has the potential to impact indigenous peoples. Under EP4, a project must undertake an FPIC process that meets certain criteria specified in IFC Performance Standard 7 if there are any of the following triggers. For instance, if natural resources, such as land or water, under the indigenous people's traditional ownership or customary use will be unavoidably required by the project, if the project will unavoidably lead to resettlement of members of the indigenous peoples from lands traditionally owned or used by them, if a critical cultural heritage will be significantly impacted by a project, or if the indigenous people's special cultural knowledge will be commercialized. Thankfully, the EP Association has produced substantial guidance on this issue, including a standalone guidance note published in September 2020, providing guidance for evaluating projects with affected indigenous peoples. There are two important points to bear in mind here. First, FPIC does not require unanimity on the part of the impacted indigenous peoples. It may be achieved even when individuals or groups within the community explicitly disagree, which in our experience is not uncommon. Second, if FPIC is not required, a process of informed consultation and participation, as defined in IFC Performance Standard 1, should nonetheless be pursued with any indigenous peoples impacted by the project. EP4 is prescriptive in that it dictates those actions to be taken by sponsors and by Equator Principles financial institutions with respect to FPIC. The requirements relating to FPIC are applied to projects globally and may be applied even in countries that have not traditionally undertaken these types of consultations, as they may not be required under host country law. This is very important because it will be a delicate process from a social perspective for many projects, and it will require good planning and assistance from outside consultants. And generally consistent with the theme of my comments today, both the topic of FPIC and the climate change risk assessment are additional long lead time items that we would advise folks to pay attention to early in the process to ensure compliance with EP4.
Josh, this has been really great and given me, and I'm sure some of our listeners, a lot of things to consider. Thanks so much for joining us.
And a big thank you from me also, and thanks to you, Josh, also for sharing your insights onto the Equator Principles, and in particular, the changes that we've recently seen. I'm sure we'll continue to see a lot more of this in the work that we're doing, both with sponsors and lenders on significant projects. So thanks again for your time.
Of course. Yeah, happy to do it. Thanks for having me.
And thanks to our listeners for checking out this episode of the Energy and Infrastructure podcast in our Connected with Latham series. Stay tuned for more episodes coming soon, where we will cover other key topics in the evolving energy and infrastructure sector. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or anywhere else you listen to podcasts. If you'd like any more information on the topics we've covered today, please email us using the links located in the show description. We hope you join us again soon. Thanks all.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 885 3rd Avenue, New York, New York, 10022-4834. Phone number 1-212-906-1200.